me, I put my, as I said, if you don't mind writing to me, to Dr. Alumni, what programming we could do. And I was thinking maybe something on Ukraine would be very topical and engaging but for everyone. So in any case, I'll put my email address here. Please do write to me, not only Dr. Alumni, anyone else. And of course, there is Srishti who can put an email address and others. Thank you all for coming this evening. As we said, we wanted to engage Dr. Alumni in more substantive manner, in deeper manner, in larger number with the Alumni Club. And this is a small effort in that direction. But now we have everyone, and we are delighted to have everyone here this evening. And with us is Venkat. Venkat is the global CEO of Barclays. And he has been so for the last 6 months, actually less than 6 months. He got appointed in November, I think. Prior to that, he was a chief risk officer at Barclays. Venkat is a doctoral alumnus of MIT Sloan School and Operations Research Center. As I mentioned, his doctoral advisor was Arnie Bonnet, statistician. I mean, you know, many of you, if not all of you, would have had a class with him. One of the most witty and one of them that makes statistics so accessible to everyone. You don't have to be a doctoral student. You could be taking the first level master's, statistics course. And after the doctoral dissertation, Venkat joined the banking industry. He has been there for the last 30 years, give and take, and over the last few months as a CEO and last 5-6 years as a chief risk officer. I've known Venkat since the MIT days, and as I said, very thoughtful and engaged and very reflective and prudent. I think so. He's a very wise choice for Barclays at this time, in this moment. He brings so much of intellect and the right ecology. I'm delighted, Venkat, to have you here. And a word about myself. I'm a doctoral alumnus of Sloan in late 1989, overlapped with Venkat. I live here in New York City. Thank you for coming. And now, Venkat, it's over to you, and you can make observations for the next 10-15 minutes, and then we'll throw it open, have Q&A, and we'll let you go home a little shy of 7.
Thank you.
Thank you.
So thank you very much, GK. Thank you, everybody, for joining. Thanks, Srishti, and to the folks at MIT for arranging this. I have known GK for a very, very long time, and I'm very happy to be part of this. I think MIT, all of us who've been there know how special it is, and anything any of us can do to continue to carry on the traditions of the institution, to help its alumni, to help the institute. I think it's something which we should all try to do. And I know that I was just seeing some of the names flash by. There are many alumni here who've done a lot for the institution. I saw Victor Menezes, a great respected banker at Citigroup, who also just joined. I saw it flash, and Victor has worked for the corporation of MIT, worked with Sloan, and done so much for so many students over so many years. So thank you, Victor. And if I missed other names, I'm sorry. So the topic of the presentation was to talk about the sustainable economy, global economy, and the market. What I thought I would do is just give you a few thoughts on how I see the current macroeconomic situation, and especially after the invasion of Ukraine, and then the linkage of that with the net zero movement, which is the sustainability goal that our bank has and many banks have. So first, to just begin with the way my personal view, take it for what it is, of the global economy. At the end of last year and the start of this year, I did feel that we were coming into a more uncertain period, and that uncertain period was driven largely by the fact that many of the market levels were at tights or wides, however you want, highs or lows, however you want to call it. And we were ending a prolonged period of financial stimulus. So at the end of December, and 2021 had been one of these gangbuster years for the investment banking market, lots of deals, lots of transactions. The IPO market had started out strong, became weaker, but equities driven by technology were basically at all-time highs. According to many, it was fueled by easy money, which had been pumped into the economy basically since the financial crisis. It had come in since the financial crisis, been removed, and then happened again during COVID. And not just in the monetary system from Fed purchases of bonds and low interest rates, but also in the fiscal system from payment protection programs and basically paycheck help for people who lost their jobs during COVID or did lose their jobs. So there was a lot of support, fiscal and monetary. Credit spreads were at an all, interest rates were at an all-time low, and stock prices were at an all-time high. And yet, through the year, signs of it were building up, not just in their amount, but in their persistence. So what we were calling a transitory inflation was not happening. It was persisting. It was related in part to oil, but also in a very big part to the supply chain. There is a broader point which some people have been making in the market about whether we're beginning to see deglobalization. I'll come back to that at the end. So at that point, at the end of December, early January, with inflation being persistent, you had to start worrying about rising interest rates. And indeed, in December, the Bank of England was the first to fire the gun, and they raised interest rates. And then the expectation, which has happened since then, was that the US would raise, the Fed would raise as well. At that point, the worries were basically that all this stimulus and liquidity in the economy had to be taken out. And the basic premise that many of us had was, if you like, that the air would be let slowly out of the balloon. There were two concerns about it, which I had expressed. One was that we had policymakers in all the major finance ministries and central banks who were dealing with a generationally sustained rise in interest rates, who were probably dealing with a generationally sustained rise in interest rates. So the last group of people who had done that were doing that job in the 80s and 90s. So there's an institutional memory that you could lose. The second thing is that inflation expectations had been beaten out of the market. So, you know, for those of you who remember the 90s, even till the late 90s, people would always talk on wage negotiations and so on of how inflation expectations were there, which had been built in from the 80s, periods of high inflation. And so even though inflation was dropping to 1%, 2%, people were sort of trying to build in their wage, or they're even thinking 3, 4, 5%. Then after the 2000s, you know, basically people had assumed that prices may not rise. Obviously, odd price rises in commodities and oil, but other than that, in a sustained way, not at the grocery store. And so at this point, you would again see rising inflation and an embedding of inflation expectations. The third thing for somebody in my seat in a bank and an investment bank in a markets business is how few of our traders, both in the interest rate space and the inflation space or even beyond, had actually traded a market where rates rose in a sustained way. Emerging markets traders had, but developed markets traders had seen it in the US probably last in 1999. So, but even with all those risks, there was a feeling that this could be managed and the air could be slowly let out of the balloon. And then you come to Russia, Ukraine. And what Russia, Ukraine does, to carry my imagery further, is it squeezes the balloon, right? Because it creates the shock, which is not just an inflation shock in terms of oil prices and commodities, but it creates a financial system shock, even though Russia is not such a big economy, of sanctions and restrictions on money flow into and out of Russia and money flow dealing with Russians outside of Russia. Now, these people don't just own mansions in London and yachts in Monaco. They own other financial assets. And we don't know yet how we will see the implications of that, but you're certainly seeing it in commodity markets. And you might see it in other areas. So when we think of the risk of Russia, there's a direct risk, which is money in Russia and dealing with Russians in Russia or Russian entities. There's the second thing, which is what I would call contingent and counterparty risks, to use fancy terms, which is risks you have with people who are themselves exposed to Russia. So you could think of agricultural companies, food companies that need to buy fertilizer, that need to buy food that is going to be more expensive, may not have hedged their inventory, may not be able to manage their cash flow, and therefore get into trouble. That's the second type of risk. And then the third, which we're beginning to see, is the broad spillover into the economy itself, because of energy prices, because of food prices, because Ukraine is a large grain producer, and Russia produces fertilizer and other agricultural inputs, and of course precious metals. And then the embedding of inflation expectations. So that event is adding stress to what was already going to be a difficult situation. In this difficult situation, even before Russia, there was one thing different about this economy or this marketplace today compared to even 15, 20 years ago, which is the prevalence and the prominence of both private equity and private credit. So large sums of money, which are in these firms, which have had a very important and significant role frankly, in our lives and in the markets, by providing capital to companies which were cash flow rich and making them more efficient. But the mark to market, so to speak, of their investments takes more time to materialize. And so there's a question of how quickly that market would respond and how it would affect the public markets. So then two added issues. One, what does this mean for net zero? And what does this mean for globalization? So let me take globalization first. I think at the time of COVID, you started to see the first breakages in the supply chain, particularly when it came to medical supplies. And countries realized, when I was at MIT in the late 80s and early 90s, the rage in operations research in the Sloan School was the interconnected world, just-in-time manufacturing. How do you make your supply chain so efficient that you keep minimum inventory and everything just works as clockwork, right? And that premise is wonderful until there's a rupture. And the world had adapted to that. And then the rupture comes with countries hoarding resources, especially medical supplies, so that they can manage their own public health before somebody else's. And you saw it across the world, every country that was a major producer of medical supplies, including vaccines, tried to save it, give it to its population first, and then gave it to others. And then from that, there were added impacts on the supply chain because of lockdowns in China and what have you. And the Chinese economy has been a force for global deflation over 30 years. And the reversal of that obviously is stimulative of inflation. And if you then go from just medical supplies to broader supply chain issues, you start seeing the unraveling. And one question for us, when Ali was leaving MIT in the late 80s, early 90s, if you sort of said to somebody where to make your fortune and they had foresight, they could go to Silicon Valley, they could go to Eastern Europe, they could go to the emerging markets and ride the wave that happened. Now, I don't know what the next 30 years are like, but I'm not sure that's the same event that's going to transpire with 30 years of foresight, right? So if we were talking in 2052 to the Sloan alumni, what would we have described the last 30 years as? So I do believe that we are possibly seeing the start of a trend towards deglobalization, which will be inflation supportive. And then the third question is net zero and the sustainable economy. The sustainable economy has been based on a move away from coal as a baseload power generation, oil and gas, and into renewables. And in a way, Western Europe is a microcosm of both the advantage and the challenges. So Barclays is a UK bank. The UK apparently is the windiest country on earth. I didn't know this myself. And so it has among the largest installed bases of windmills and wind power, both onshore and offshore. It also has solar, which for those of us who think about the stereotypes of the UK, we do wonder about it, but it's there. But here's the problem. Over the last 30 years, the UK has been reducing its amount of generation from coal and from nuclear. So the so-called base load, the base of electricity that has zero marginal cost, next to zero marginal cost, but a huge fixed cost, has been shrinking. Then there's a middle, which is oil and gas. And then there's the top, which is renewables. The issue with renewables is because we don't have reliable storage, renewable power itself is less reliable because the sun does not always shine and the wind does not always blow. So sometimes you get a little bit of reduction from the top, you've reduced the bottom in base load, oil and gas takes its place. And that makes these economies more vulnerable to the supply shock they've just had from the Soviet Union, from Russia, and the price rise. So the interesting question for all of us is going to be, how do you balance energy security with the move towards net zero? No clear answer, but increasing nuclear may be part of that answer. And because it is, I mean, the technology itself is 70 years old, there are more developments recently, including smaller reactors, which may help with the radioactivity containment problem and the waste management problem, and the cost issue, because these things are very expensive. But I do think that I don't think that the impetus towards sustainability and a low carbon economy will change. We have to keep at it because of the climate concerns. But what is included in it, in that perimeter, may change because nuclear may be the offset that certainly the advanced Western economies need. But I think, at least for us and the way we think about it, there is a trade-off between the goals of what you want to achieve on the climate side, what people call energy security now, and what people have always called energy justice, which is the fact that growing economies in the developed world, in the developing world, in Africa and India and other parts of Asia, do need more power, and for them the cheapest power is based on. So it is that trade-off between the climate goals, energy justice, and energy security that is the interesting trade-off. Now, we actually in Barclays, if I can advertise just a little, have an interesting experiment going on, which is we have put forth what we call a Say on Climate, which is a resolution in our annual general meeting in May, where we've laid out our climate goals and we've asked our shareholders to vote for them, yes or no, right? And I mean, I believe in our goals. I believe in what we are trying to do to transition our financing to fossil fuels, but it's going to be interesting to see. I think we're the first major bank to do it, to offer what is called a Say on Climate. And actually, one of the things that happened was when we had we were about to publish it and the Ukrainian invasion happened, there was a question, should you affirm those goals or not? And we decided to affirm the goals. Of course, we are alive to the fact that national security or energy security may make us, in certain countries, adapt those goals. But I do think it's important to keep the goal towards net zero. So with that, I'll stop. I think we have roughly about 20 minutes for questions. GK, I don't know if you're going to be the...
Well, I mean, I'm looking for questions in the chat.
I see a couple.
There's one which is, what is the feasibility of safely generating nuclear on a massive scale and delivering it? You see that? Did you read?
I see that. Look, I'm not a technical person,
Yeah.
so I don't really know the answer to that. I think delivering it from source has been done, in the US in advanced economies for quite some time. But I do think that the safety questions and so on will be back on the table. I think nuclear will be back on the table, certainly in Western Europe, because there is no alternative. There's no cheap, easier alternative. And the French have had the capacity for many, many years, even the Germans do, and of course the English do.
And there's another one on inflation. You read it? If inflation is caused by supply chain disruptions rather than loose monetary policy, do you read it? Or how will central bank react?
Inflation is caused by supply chain disruptions rather than loose monetary policy. Will central bank interest rate increases help control inflation? Look, I think there are many causes for inflation. One cause is the supply chain. Another is obviously what's happening in the energy markets and inputs into food and input into metals. So all the input prices are going up. In the end, what increases in interest rates try to do is to curb demand by making it more expensive to borrow and to buy. So it will work. You may have to do more than you thought if you did not have these issues. But it will work. The question really for all of us is how high does inflation have to go, or how high will inflation go before it gets under control because of these different structural changes? What will happen to growth in the meantime? And what will happen to unemployment? We are lucky that we are starting at a point when unemployment is low, and in the Western world, consumer balance sheets are very strong because people have had money both from government programs and from lack of spending. They have not been going on vacations. Can you speak more about the availability of green bonds? Are companies taking advantage of these products? How else can the financial industry impact global climate goals? So green bonds are becoming more and more available and more issued. The question about green bonds is, what is a green bond? So for instance, companies issue a bond and they call it a green bond because they try to meet some standard in their operating business, right? I will use, this green bond is used to fund a building which is energy efficient, something like that. The criteria are different bond by bond, and it's hard to monitor. So there's no standardization. And I think that's one important thing that the financial industry can do. I think the other part about the financial industry is it's not just reducing the amount of money lent to fossil fuel developers, to oil companies and so on, but it is about providing the incentive for people to improve energy efficiency and to borrow and to provide enough financing to the new renewable energy projects around the world. Now, inevitably, some of these projects are not going to work out, and there is arguably a bit of a bubble going on. But for instance, our own bank, we have a green mortgage program in the UK, where if your house has a certain high energy efficiency rating, you can basically borrow at 10 basis points less than you otherwise would. The other thing about it is that, I think what more needs to be done is that's a relatively small fraction of houses. And in fact, the move to a net zero economy is a regressive tax. The person who has the $100,000 Tesla and charges it does not really care about the price of gas or the price of electricity. It is the person in an average family which is trying to deal with the pressures of the energy bills that has to pay this. And so that's where I think it's important to be able to provide financing to improve energy efficiency. If China and the West move apart, not completely, but in a major way, what would be the impact on the West, China's, and the world's GDP? It's a hard question. Look, I will fall back to classical economic theory, which does say that trade and competition leads to greater prosperity around the world. And so if you believe that, and you curtail trade, you would expect the opposite to happen. I'm sure there are always special cases. And I hope my economics teachers at MIT don't yell at me for having forgotten what they taught me, but at least that's my simple view. What's your take on the carbon tax? And what are key approaches for sustainable economy? I think the way ultimately that governments will continue to help the climate change or the fighting of climate change is through both incentives and taxes. The problem of carbon taxes is not per se that you can't implement it, but it is a regressive tax because fossil fuels are still the cheapest form of fuel. And people who use it tend to be more from the more economically weaker sections of society. And a carbon tax, especially at the end user level, is a regressive tax. It hurts those who can least afford it. And so you have to be able to find a way to do a carbon tax that spares the impact, I think, on those who can least afford it. What's the impact of Russia, Ukraine on the financial institutions, especially their ESG progress? I think it's what I said, that it puts energy security on the front burner. And to the degree that that becomes an important issue, then you have a question of whether the progress slows. I hope it doesn't, but it's a question. China has banned private cryptocurrency. Could that happen in the West? How large could it grow in the West? You're talking to a bank person. We don't do much in crypto, in part because our regulators across the world don't really allow us to. And there's a lot of public material out there, whether it is a true form of currency, whether it is a store of value, a unit of account, which it is, a medium of exchange, which it is becoming. I think the interesting thing in the financial world to look at, in the more regulated world, is the notion of a central bank digital currency. There have been some initial papers, both by the Fed and the Bank of England, and I know the Chinese are trying to go forward with it. The issue with the central bank digital currency is today what the central bank knows is that I have this $5 bill. That it knows that this $5 bill has been printed and it's out there somewhere. It does not know that this $5 bill is with me, right? Because nobody is tracking this serial number and saying, where is that serial number sitting? The central bank digital currency allows them to do both. It will know that there's a $5 bill out there, and it will know that it is in GK's pocket. So now you see why the Chinese like it. The issue then is, in effect, what you're having is a bank account with the central bank. And question is, the central banks don't do that. They don't have bank accounts for tens of thousands of people. Even if they let you do the bank account through banks, regular banks, the question is then who does what is called credit transformation and credit maturity? That's the role of the banks. It's the role of the banks to decide who gets credit, how much to lend, when to lend, for how long to lend. And if you get it wrong, banks lose money. That's not the job of the central bank, and at least for a few hundred years of Western financial institutions, that's been the way. So I think those important questions have to be addressed for central bank digital currencies. And there's a whole bunch of technical issues about, just actually how to build the pipes and so on, and how to do the accounting. I'm not saying it won't happen, it probably will happen, but it won't happen tomorrow morning.
Any other questions? You can unmute or you can type. Srishti, you had one which got lost in the, maybe I saw that, but maybe you can ask that now, Srishti.
Sure, thanks, GK. Hi, Venkat. My question is, with the repercussions of the non-sustainable practices we are already seeing, do you think we'll be able to adopt all the sustainable practices that we are talking about in right time? And if so, what are some of the key things to keep in mind, both from corporate's perspective as well as from users' perspective?
So the question is about sustainable practices. I think a lot is already happening. And I think most companies are looking very hard at this. And I think, by the way, I think some of the new ways of working that have come after COVID are very helpful to this. I mean, just look at all of us getting together here. If we'd done this 3 years ago, GK would be hosting it somewhere in Midtown Manhattan, and all of us would have taken some form of transportation to get there. Now we're not doing that. But it's happening in business in a major way. I can tell you that having worked in business, even now, though people are back traveling, I'm back traveling, there are many, many meetings that we're doing virtually that, 5 years ago would have been unthinkable, and we would have all insisted on going in person. So I do think some of those sustainable practices are here to stay, helped in part by what happened with COVID. And I think companies are moving fast. I think the ultimate question is, while there are high levels of profitability and growth in the economy, people can bear the cost. When that turns, will they be able to bear the cost? And what will be the cost of fossil fuels? Then ultimately, some government help will be needed, more innovation is needed, and perhaps nuclear to bring the cost of what we would call green energy back down. Not back down, but keep it low.
Yeah. Some other new messages, maybe Venkat, you see that? You can read as well as I could.
Barclays is still targeting to reach net zero by 2050. Can you elaborate? Can't we be more aggressive?
Yeah. If you want that, there's another one for you. No.
Look, let's put it this way. This is the only question about Barclays I'll answer.
Okay.
That is still our target. These are very, very difficult targets to reach, in part because you're betting on technologies that don't exist. For a bank, becoming net zero in our own operations is fairly easy, right? We're not energy producers. We consume energy, but we can do carbon offsets. Even our travel in the grand scheme of things is not much. What it is for banks, it is how much do we lend to companies who themselves are net generators of greenhouse gases. And the problem is you can't go any faster than the economy. Just give me 1 second, I'm sorry. Hello. You can't go any faster than the economy. And so, for instance, if X fraction of the global economy is airlines, and airlines are not able to find some cheap, usable form of hydrogen that can do transportation by 2050, well, then that segment and our involvement with airlines, and nobody's telling banks we shouldn't support airlines, will not be net zero. Right, so we have to find that. We're relying on storage technologies. We're relying on the globe's own progression. What we try to say is this is our ambition. And so we're going to try very, very hard to meet it. But there's an error margin around it. So that's why I think it's unrealistic to try to come up with a more aggressive tempo. Because you have to do something. If there are great technology developments, you'll be there faster. And no one will be happier than me if we are there faster.
There are two questions. You can answer them a minute each. That'll bring us to 6:55, and I can say thank you, and then you can go home within 4 or 3 minutes of 7.
Will deglobalization and increasing geopolitical risk, will money flow more to developed economies? And what would be a reasonable strategy for banks? I think emerging market economies anyway have suffered more from COVID than developed economies. And I think deglobalization does not necessarily mean less flow to developing economies, because the very large countries in the world can be self-sufficient. The smaller countries cannot. And so some amount of trade will exist. Like the UK will never be self-sufficient, right? It continues to have import food from Europe, and so that the UK is a developed economy, but if you take smaller countries in Africa, they will still rely on exporting raw materials and importing finished goods. It'll be quite a while before that changes. When we faced the last financial crisis, the US financial system was within inches. How well are we protected? I think we are much, much better protected. The banking system is much better capitalized. Risks are better understood. You should never say never, but I think there's a great reason to be much more confident about the banking system today than 15 years ago. So with that, let me say thank you. Thanks, GK.
Thank you, Venkat. Appreciate it. And Venkat serves on the Golub Center for Policy, Public Policy in Sloan School on the advisory board. Is that right, Venkat?
Yes. Yeah.
And thank you for, just this comment. I never thought too much of globalization, though it's a very fancy thing in New York Times and others, because I tell people today we have 193 sovereign countries, each of them making their own rules and regulations about movement of goods and people. So there is some information, globalization, but the rest of it is still, we're probably more globalized in 1900 with only 30 centers of decision making, Monroe Doctrine and South Asia and all that. But having said that, thank you, Venkat. Thank you for the evening, the session. And to all my friends, thank you for coming. If you have any ideas, suggestions, send an email to me. And I also wear another hat on South Asian Alumni Association. We are trying to initiate a group on sustainability network. If you're interested, write to me. And thank you, Venkat. We'll be in touch. Best regards. Have a great evening. Thank you.